And let's look at these accounting cluster models now. And this is to help us better understanding the differences in accounting around the world. So we have different accounting models, the fair presentation and full disclosure model. And that's really promulgated by the Anglo-Saxon or Anglo-American model. So you're talking about Britain, UK, Canada, all the Commonwealth countries, some of the European countries. And so it's very much fair presentation, full disclosure, and that's going to create maximum value for the company in the eyes of the shareholders. Now remember, as I said earlier, those type of countries also are basically under a common law, where the major shareholder are the private, not the state. So you can see why fair presentation, full disclosure has come about. It's orientated towards the decision needs of large numbers of investors and creditors, and it's used in English-speaking countries influenced by United Kingdom and United States. Then we have the legal compliance model, as I said earlier, likely related to the code law countries. And this is a continental European model. It's very legalistic. And accounting, the role of accounting is you use provide information for taxation and government planning. Remember what I said earlier? In these type of countries, your taxable income equals your accounting income. Whereas in the Commonwealth law countries, in the first one, under the fair presentation, full disclosure, taxable income is different from accounting income. So therefore you create a deferred tax account that looks for deferred tax assets, deferred tax liabilities. That doesn't exist in these legal compliance / code law countries. Finally, we have an inflation adjusted model that resembles the continental European model and requires extensive use of adjustments for inflation. So, what have academics done to actually bring all this information into something that we can digest in little chunks? Well, there was one judgmental classification of financial reporting developed by Nobes, and Nobes called it the micro-based Anglo-Saxon model and the macro-uniform continental European model. In short, basically the micro-based is really the bottom-up. That is, it's actually driven by financiers, it's driven by the source of capital, individual investors, wealthy individuals, the private sector. Whereas the macro uniform model was sort of top down, because a lot of the financing for companies was originated by the state. China is a good example, and a lot of continental European countries are in that bucket too. So we have micro base, bottom up, macro uniform, top down. So here's what this PowerPoint slide explains in terms of the micro-based accounting systems. A subclass influenced by economics, accounting theory. There's a second subclass influenced by business practice, pragmatic, as I said, influenced by the private sector. The macro-uniform, on the other hand, is more influenced by the state. And so a good example of one subclass is Sweden, and another subclass is Germany, Japan, and the southern European countries, which are really, when we say a law-based family, we mean accounting law-based family. When we say tax-based family, we're really saying that everything, the way accounting is accounted for, follows strictly how the taxable income is generated. So again, we're throwing around lots of terms: micro, macro, common law, code law. As we can see, these are kind of in the same type of groups. Micro, very much common law. Macro, very much code law. Micro, common law, bottom up. Macro, code law, top down in terms of the source of financing. Can you see there's some trends going here in how we're trying to classify the systems of diversity around the world? And so as you can see in this judgmental classification, The macro-micro is going into some subclass, and then there's a different family, whether it's law-based or tax-based. Just to be clear here, when we say law-based, we mean accounting law-based. And then we have the bottom family, US influence or UK influence. There's not much difference there because they are both influenced by the bottom-up source of private capital. And then we have specific countries that are representing these different subclasses. But at the end of the day, the biggest difference is in terms of the bottom-up subclass, of the micro-based countries, and the top-down approach of the macro-uniform code law legalistic-based countries. So we want to finish this chapter with the influence of culture on financial reporting. That's the big question. We've seen the differences, we've seen the reasons, and we've seen the problems that's caused, and we've tried to classify these differences. Code law, common law, okay, micro, macro, okay, commonwealth, okay, individual countries. All right, top down, bottom up. We've tried to classify. One other further approach to classification is in terms of the national cultural differences between the countries. And I like this area. Why? Because I actually studied cross-cultural psychology for my PhD, where I actually compared different Asian countries, Singapore and South Korea to be specific, in terms of how they are different. We know they're both moderately individualistic, more collectivist, and higher power distance compared to the West, but are there any differences between those two countries? That was part of my thesis. But let's get back to chapter 2, shall we? Is there some way that we can classify countries in terms of their cultural differences? And what we mean by culture, we mean the collective programming of the mind, where groups of people in a country share the same norms and values in terms of way of thinking, which leads into ways of acting, which leads into the ways of making decisions. And it's this collective groupthink that we try and characterize as a particular culture attribute of a country. So the first famous person to actually look at these cultural differences was Gerd Hofstede, with his famous study of IBM back in 1980. Hofstede came up with 4 different cultural dimensions: individualism, power, distance, uncertainty, avoidance, masculinity. Later on, he came up with long-term orientation, or other authors have said this is Confucian dynamism. And that was used to really specifically explain the reason behind the rise of the East, the rise of the 4 dragons: Hong Kong, Singapore, South Korea, Taiwan. Why were they able to rise so quickly in a space of 20 or 30 years? And we put a lot of that down to their long-term orientation, their hard work, the collective values towards one nationalistic goal. Whether that's true or not, this is how researchers in this area have tried to associate cultural dimensions with particular economic phenomena that we see in different countries. Individualism versus collectivism, that really gets to the heart of whether individuals see themselves as more important than the collective. In Asia, individuals tend to be less important than the collective, whereas in the West there was a greater emphasis on the individual values, their ideals and their actions, whereas in the East Asia it was more focused on the group think, the group behavior, the group action. It's not saying one is better than the other, things change over time, but these were very specific cultural differences that Hofstede realized in actually comparing the managers in the subsidiaries of IBM across many different countries in his initial study. Power distance, that is the distance in the power of people in the hierarchy. When you really see yourself as equal to your boss, then you're more likely to be in a country where the hierarchy is smaller, the management hierarchy is flatter, and you could go out and actually argue with your boss, where in these countries where power distance is lower. Or you can go to an extreme power distance country like South Korea, where you go into the office where I witnessed and there were just desk after desk lined up after each other, and guess who was in power? Who was the most powerful? Was the person that sat at the back of the room watching all of the subordinates at the front. Who had the least power was likely the employee who was in the desk right at the front of the room. It was amazing. And I asked these Korean companies, oh, how many manager levels do you have in a hierarchy? And they said 10, 11, 12, 13. It really depends how large the company is. And so that was a big revelation for me in really understanding what power distance meant when you see it in an organization. It's nice in theory, but it's so revealing to see it in practice when you go onto the ground. Uncertainty avoidance, that was more about the comfort level with uncertainty and ambiguity. And so this was a tricky one because it was more about the propensity of individuals in different countries to their attitude towards risk. Whereas some countries where very high uncertainty avoidance, the attitude towards risk is to back away from risk and to preserve capital, protect risk at all costs. Other countries, they're more likely to take risk and actually see that as an opportunity. Next was masculinity, and that was more about the equality between males and females in different countries. And a good example was Japan, very masculine, where the males were seen as more important in the business context than females. And there was other countries where masculinity was much lower, like in the US, where there's much more equality between the two sexes. Long-term orientation, as I explained earlier, that was put towards explaining why we had this East Asian miracle, the 4 dragons, and probably why we continue to have that today. A lot of scholars use that to explain that as the justification. So there you have, you've got these different cultural dimensions that are different across different countries, and you're probably thinking, what has that got to do with accounting? What has that got to do with accounting diversity? So Sidney Gray, professor in University of Sydney right now, he came up with these accounting values that are related to the different cultural dimensions, and this was over 20 years ago. And what he came up with this notion of, well, there are these different accounting values that explain a country's accounting subculture. Professionalism versus statutory control. Uniformity versus flexibility. Conservatism versus optimism. Secrecy versus transparency. You could just about guess how code law and common law countries would be different. Like common law countries are more likely to be professionalism versus code law. Common law countries are more likely to have flexibility, they're more likely to have optimism, and more likely to have transparency. And the code law countries are more likely to have each of the opposite: statutory controls, uniformity, the tax and accounting rules are the same, all right? Conservatism, because it's really dictated by the state, and more secrecy, because the state has a greater role in how business is transacted. So Sidney Gray came up with these accounting values, and he believed that national cultural values affect accounting values. And he gave an example that accounting values of conservatism and secrecy have the greatest relevance to the differences in the cultural values. So let's have a look at how he extended Hofstede's framework to link to these notions of conservatism and secrecy. So we came up with this framework of accounting systems development. That is, we have these cultural dimensions, and let's have a look. We zoom right through to the square in the middle of your PowerPoint slide under cultural dimensions: individualism, power distance, uncertainty avoidance, masculinity. And so they are linked to the accounting values of professionalism, uniformity, conservatism, and secrecy. So for example, with high power distance countries, we would expect things to be more conservative. We expect things to be more secret, because what you want is conservatism and secrecy. They go together, but the secrecy is very important in a high power distance country because it enables the people that are at the higher power in that high power distance country, the bosses, the state, the big investors, to maintain their power influence. You see, the more transparent they are, the less power, the more power they're going to lose. So a way of keeping power is to be more secret. And so this is how Sidney Gray tried to link some of these cultural values to this notion of secrecy, this notion of conservatism. Again, right, if you have lots of power, how do you keep your power? The best way to keep your power is not to share too much information. The more information you share, that is, you're being less secretive, you're being less conservative, then you're going to give up power, because then people can use that power against you. They can use that information against you in negotiations, in merger and acquisitions, in bidding for different IPO issue prices, you see. So it's very important to try and understand that power distance is a big cultural factor that can be related to these accounting values. So get into chapter 2 to have a look at how culture, some of the other cultural values relate to some of these accounting values. I think that's a big takeaway you want to look for in the last third of chapter 2. Religion and accounting, I guess we're finishing up with this, but the big difference we want to note here is this recent development, probably the last 10 or 15 years, under Sharia, the Islamic law of human conduct that's derived from the Quran. And I think the big principle out of this law is that if you loan someone some money, you cannot charge them interest. And you probably think, well, why in the world would someone do that? Well, have a look at the evidence. This sector of financing is growing, especially in Malaysia, especially in the Middle East, and a little bit in Indonesia. It is growing, and it's a growth of business that cannot be ignored. So have a look at that paragraph about religion and accounting so you can have a better appreciation of a new sector of growth in the financing world. Okay, so we've gone through a lot of different things here. There's a lot of moving parts here. Let me give you another summary, okay? Remember, we started off, there are differences across countries. There are, number 2, reasons for these differences. Number 3, these differences cause problems, okay? Cost money, okay? There's problems in administration. They cost money to list. There's a lot of issues here, okay? There are risk problems when you come to merger and acquisitions. Just got to do more work, okay? And then we tried to put these differences into some framework. Micro, macro, common law, code law. You with me? Commonwealth versus non-Commonwealth countries. All right, and so we can start to begin to see that there are aggregate bits of these diversities. We can aggregate them into different clusters of countries around the world. I guess what would be nice right at the end of this chapter is to come up with a simplified model, and this is what we got here. There's a simplified model put together by Nobes, and that is Class A type countries, and it's driven by the country's financing system, and you can guess strong equity outsider system, less conservative, extensive disclosure, accounting practice that differs from tax rules. I said that before. Which group was that? It was the bottom-up group, where a lot of financing comes privately. Or we look at Class B. I've said this before. Weak equity outside shareholder financing, very strong state financing. More conservative. Disclosure is not extensive, and accounting practice follows the tax rules. I told you that before. This is very much top-down, where the state gets involved. There's no differences between accounting and taxable income. Therefore, you don't need to have a special account for deferred income tax liability and other accounts like that. Whereas in Class A, you do have to have that to account for the different incomes under tax law and accounting law. So there we have a simplified model. It's basically summarizing what I said earlier. I'm glad that this is not a new model, but it basically puts into the two groups what we tried to aggregate earlier. Further evidence of accounting diversity. And so again, chapter 2 really finishes up with categories. There are categories based on accounting differences, whether financial statements are included, financial statement formats, the level of detail in financial statements, terminology, disclosure, recognition, and measurement. So, these are all the specific differences that we would see around the world. Have a look at the Verizon statement and the Vodafone statement in chapter 2 of the textbook, and you can actually see examples of each of these accounting differences. And there we have end of chapter 2. At last, big chapter. Okay, again, the takeaway is, look, there are differences out there. All right, we know here are the differences. All right, terminology, disclosure, the financial statements included, this formats, level of detail, recognition, measurement. All right, these are differences. There are reasons for these differences, but there are problems. Also, problems caused by these differences. And the second half, the last third of chapter 2 focused on the reasons for the differences. And those reasons could be because the way the state is set up, all right, the legal system, the sources of financing, okay, the national culture, religion. There are all these different reasons that have come together to give us that diversity in accounting that we see today. So go back into chapter 2 and try to make some connections. So when you get to the last third of the chapter, you can actually start to see why some of these frameworks fit together in the way that they do. I hope you're excited about it. Keep moving. We'll get into some calculations in a few weeks' time, but right now we're just trying to understand that there is diversity out there, and we just want to understand the reasons for that diversity. Catch you in the class, and thank you for listening. Bye for now.